Hello traders, welcome to FreeFX. I'm Francesco. Today we're going to talk markets. It's the day that the US is off. It's Independence Day, 4th of July, 2022, 346 years since it became independent from the United Kingdom. And what a day it's been. Nothing's happened with the S&P 500. It's been very slow. This is a 1 hour chart. You can see the ATR has really plummeted to amazing lows. And through the day, it's just got weaker and weaker. So the European session, when the US should have been online, nothing much happened. Equally on the candlesticks, you can see tiny movements. And on the CCI, we're kind of stuck around the 0 level. So not much progress. If I take you to the 4 hour, which is my favorite time frame, not much has happened. We crossed the 0 line earlier today, but then kind of stayed in this no person's land. On the ATR, again, plummeted, and the daily is no better. So let's go to the daily, and just to show you exactly how slow we are. Our ATR falling since the 16th, actually, of June. So it's been a recurring problem, the drain of, volatility, really, through the start of the summer holidays as well, and the Independence Day holiday. It's a big thing. Obviously in the US and the UK there is no holiday at the moment, but even so the markets are responding with very little movement. On the daily we are still underneath the 20 SMA, the middle line for the S&P. Bollinger Bands set here at 21 periods and 2 standard deviation. Now we are still underneath that 20 SMA. So next week we might move away from that. Certainly tomorrow I hope that with US markets being back on, we might see a bit of movement there. But if this week doesn't move it, then hopefully next week. The Fed rate decision is at the end of July, so we have a fair amount of waiting to be had. So we are going to be on the Tuesday the 26th and the 27th of July. Wednesday the 27th is the day that the FOMC, or Federal Open Market Committee, will release its rate decision, which has been telegraphed before, potentially 75 basis points up. And until then, we have a lot going on around the world, a lot of metrics telling us that not all is well, not just in the capital markets, but in on the high street. And these things are weighing on a lot of money markets, not just this index. Therefore, the downtrend, in many people's opinion, isn't done yet, and we would be wise not to call any bottoms and say that's the end of the bear market, it's the end of the downtrend, etc. I personally trade both ways. It's not a concern for me. It's a different environment for investors or people who have bought into the bull markets as a concept, and this is a difficult time for them, so all sympathies. Now I just wanted to kind of show you another thing as well, which is if we take this to point and figure charts. If you're not familiar with these, I had a conversation with Chris Caddy on Twitter the other day, and he did acknowledge that he had used these before. I've never spoken to anybody who used them before, so thank you, Chris. And also it's something I studied for the CMT Chartered Market Technician Level 1. That was during the pandemic year 2020, and I came across these charts which look quite esoteric, but essentially they are used to take out the element of time from charting price, and you only really add an X for an up move and an O for a down move when price moves a certain amount. These are called boxes, so every time you have a move of a certain box size, let's say that we set the box size to be $1, every time price moves up $1 we add an X, and if it moves down $1 we add an O. Until it moves that amount, it doesn't matter how much time it passes, we don't add an extra an O. So what you see here may look like the chart is defective because we only have 10 columns, but in fact that's a huge period, because as I said, if nothing moves for X days, etc., we don't add next. So that's basically dead chart in terms of having a history there to look back on. But what this shows you is that over a very long period of time, since 2008, in fact, as you can see, we have had the Great Financial Crisis. That's the downtrend in there. Then a bull run, then a down, 2018, then 2020, the pandemic, then 2022. Now for 2022, we've actually had 3 columns because of kind of various movements. But essentially, let's call this just one downtrend, 2, 3, so 4 bear markets since the early 2000s. Obviously, there have been many more before that. The 1987 crash, the Asian crisis of the 90s, the dot-com bubble burst, and so on. So these are very good charts. They point and figure to kind of briefly summarize the mood of the market in a very short chart, essentially. All right, let's go back to what I was going to show you as well, which is I've been listening for years now. I'm sort of quite an avid consumer of the videos made by John Kicklighter, who is the chief strategist of Daily FX. So what he tends to do more and more through the years is sort of expanded from just Forex to, well, just Forex, I mean mainly Forex, to kind of a whole market analysis, and he really does kind of break down the relationship and sort of relative strength as well between different asset classes. So in a sort of homage to him, I'm going to just briefly show something which is kind of very simple, simple version of that. So I'm going to take out the Bollinger Bands because we discussed them already, and I'm going to take out as well, just to make more kind of chart space, I'm going to discuss a few things. So take out these, and now we're going to change that to a line. Therefore, this is what we're going to get. Now, we have to show you these because it's very important to, as I said, have a broader view of the market. So the first thing is the FTSE 100. There's a FTSE there. As you can see, there's a distinct difference between the US index or S&P and the FTSE. And if you go back long enough, you can see that pre-pandemic we had an up run, obviously, as the pandemic hit. And then we sort of stalled at the top there. The 2018 was a dip for both the FTSE 100 and the S&P. Subsequently, the S&P posted new highs. The FTSE didn't. And what is really interesting is if I put just a very simple trend line, I'll put a horizontal line, the easiest thing to do, and I put it here. Okay. You can see that the levels that the FTSE is at are actually lower than these tops from 2018. So we're about here, which is basically the same as 2017. We're just roughly at these levels. Actually, we're a bit lower now, but in May, certainly we hit that peak. So the FTSE is actually stuck in a sort of 5-year period to the same kind of resistance kind of roof, and this roof has really held, whereas the S&P sort of went higher if you compare its performance from 2017. So the S&P has suffered a greater loss relative to where it's got to than the FTSE 100. And one may speculate as to why that may be. I'm not here to say why, but certainly there's a distinct difference. However, if we went and looked at the other graphs that I've got for you, this is the German DAX or German 30, and as you can see, there's a distinct positive correlation between it and the S&P 500. And if I did this, now you can see the Junk Bonds ETF, one of its manifestations, that's the CBOE version, and you can see the three overlaid, and the 2020 pandemic hit all three hard, but the difference is that like the FTSE, the junk bonds haven't really recovered and they've tanked. So they are now at these levels, resembling the V bottom of the 2020 pandemic. So I'm just going to close these, because the last one I'm going to show you is not an index, it's actually a currency pair, a forex pair. This is the Euro USD. Very interestingly, we've seen a decline from the 2008 financial crisis, where we hit these highs at 159, almost 160, and now we're sort of loitering around 104. So that's a huge difference. About 5,600 pips or 5,500 pips. And but what's remarkable as well is that whilst the S&P has kept climbing, the Euro USD, or let's call it the Euro, has actually kept declining until we got to January of this year, where the Euro and the S&P now show a very positive correlation. So if you look at the two side by side, or the one on top of the other, the Euro had a little climb here post-pandemic, and it sort of topped around the end of 2020, and then from January until May it struggled, and then from May 2021 it started declining. Almost an advanced warning of what might happen to other markets, and indeed the S&P eventually followed. That's not a causation that the S&P fell as it did over 20% because of the Euro, but it's interesting to see that these two have aligned, because they don't often do so. Obviously the flip side is that the Euro has done this because of dollar appreciation, and indeed we can have a look at that and see how that compares. But the dollar index is heavily weighted on the Euro, obviously, so it's a case of making sure we understand that correlation. Is the dollar is a basket currency, as an index, DXY rather, is heavily weighted on the Euro. I think it's about 60%, and then other basket of other currencies like Aussie and pound, etc. So if we had the US dollar, for example, just the US dollar, I don't know, let's call it US dollar futures, and show that as a US dollar. It's always tricky because there are so many versions of it. There we go. I'm going to use this one, new price scale. There we go. US dollar index, courtesy of Pepstone. Here we go. So you can see that the dollar has obviously yo-yoed a lot, but we've got to this level now, and it means we are at record highs since quite some time back. This one doesn't go any further back in time than 2016, so only 6 years. But we had these peaks, and we are just shooting up higher and higher. So you can see the almost direct negative correlation between the dollar tanking and the dollar peaking and the S&P 500, although they are not mirror to each other. But certainly there's an implication that the dollar bid is through the Fed rate hikes, quantitative tightening, QT, that money supply is coming off the conveyor belt, so to speak, in the system. S&P is becoming expensive, and so on and so forth. So that there is a correlation, although it's not chart based. It's kind of wider. So at the end of all that, we have a few days left in the week. Always worth remembering that anything is possible in the markets, but we had a very quiet start of the week, so really tomorrow is going to be the day when the US markets come back online, and I'll be looking forward to seeing how price develops. Thank you very much as ever, and I will see you in my next video. Bye and happy trading.